Welcome to the Bourse Report. I am Marjorie Seaburn, and I'll be holding on for Cyril today. Today, we'll take a look at the 9-month performance of the international markets, with more focus on the US market. It's been another strong performance for international markets, and in particular the US market, where we've seen healthy capital appreciation in all indices in the 9-month period. So we'll start off with the S&P 500 and its performance in the 9-month period, up 13.7%. This follows two strong years in 2023 and 2024, 20-plus returns. In the last 45 years, the S&P has been up over 20-odd% in each year. It's definitely a very strong performance. The Nasdaq up another 17.3%, continue to ride the wave technology-related securities, and the Dow up 9.1%. It has not been smooth sailing for the indices for the course of the 9-month period. At the beginning of April, we would have seen sharp declines in all of the indices during 10 and 15% with the introduction of Liberation Day tariffs by the Trump administration. This would have impacted markets negatively, but with the suspension of the implementation of the tariffs around April 9th, we saw some recovery in the market, and we've seen that recovery continue on for the rest of the 9-month period, and closing off at the 9 months with very healthy returns as trade negotiations with a number of trading partners of the US have been completed and successfully implemented by the different countries. When we look at sector performance of the US index, we see mixed performance by some of the sectors. The consumer staples and the healthcare, both defensive sectors, underperforming significantly some of the other sectors. The consumer is in negative territory, minus 0.3%, and the healthcare only up 1.2%. The communication sector and the technology sector continues to do very well. The communication sector with companies such as Netflix, Meta, and Alphabet. And the technology sector, the biggest security in that sector will be NVIDIA, which crossed the $5 trillion market cap this week, as well as Microsoft, as well as some other large cap companies like Broadcom. The industrials with companies such as GE Aerospace and Caterpillar also performing very well, up 17.1%. In terms of earnings growth year on year for components of the S&P 500, we've seen aggregate earnings growth continue to be very healthy in the first 2 quarters of this year, up 13.7% year on year and 13.8%. Expectations for third quarter earnings growth is at 10.4% and a weakening in the last quarter of this year, 7.9% overall. Very strong earnings growth despite challenges both local and international in the US market. This year, earnings growth for the S&P 500 is expected at 11%, following 12% last year. And for next year, a still healthy 14% earnings growth. And this is important when you look at current valuations. The US market is a little rich by historical perspective. The current valuation at around 28 times PE multiple. Historically, the 5-year PE is at 25 times and the 10-year is at 22 times. But when you look at forward, the expectations by market analysts based on their earnings growth forecast is for the PE valuation around 22 based on 2026 earnings growth. So forward looking, 15 months here, 15 months out, it's not as expensive, but definitely on a trailing basis, relatively expensive. But the views are mixed in that the investments in IT and the growth in the IT sector warrants a richer valuation. And generally, we've seen performance of the IT companies overall have been fairly strong. There are 1 or 2 exceptions, but it is supportive of market sentiments and valuations to some extent at this point in time. We switch our look at the performance of regional ETFs in the international space, and we've seen strong performance in most, if not all, the regions in the international markets, and this performance is both a combination of capital and currency appreciation. The US dollar would have fallen in a 9-month period around 9% against major international currencies. And definitely, we've seen appreciation of many of the emerging market currencies against the US dollar. When we look at the Latin American index as represented by the ETF is up 38.2%, and this is, again, currency and capital appreciation. The Brazilian real is up 13% against the dollar, as well as the Mexican peso is up over 10% at the 9-month period. Last year, the Latin American index would have underperformed the market as the currencies would have taken significant hits. In the European market, the euro has appreciated around 11% at the 9-month period against the US dollar. And we've also seen strong capital appreciation by many of the markets, if not all of them, in the European space. The Asian market is also up year on year and much greater index performance than 9 months of last year, 26.4%. Most of this gains is capital appreciation. Currencies have not appreciated against the dollar as much as some of the other regions. And the US space, the S&P 500, it's up 30.7, a bit weaker than last year. The 9-month period is up 20.7. So generally, very strong performance across the board, and investors have definitely benefited from capital appreciation in all regions of the markets this year. And when we look forward in this quarter and into the new year, some of the drivers that could impact market performance as well as market sentiments. Relative slowdown in GDP growth. IMF forecast GDP growth at 3.2% this year, global GDP growth that is, and next year 3.1%, and this follows 3.4% estimates for last year. And the US markets, the GDP forecast is for 2.1% this year and 2% next year. So marginal decline in GDP forecast at this point in time, but we don't expect this to have a significant impact on the market because it's still relatively decent earnings, GDP growth overall. Inflationary pressures could impact the US market. Current inflation stands at around 3%. This as compared to the targeted rate of 2%. So inflationary pressures due in part to higher tariffs with the introduction of tariffs for imported goods. That has filtered down into the market and may impact the market going forward. And if the US is unable to control inflation, the outlook for interest rates cut could be lowered. This year so far, in recent months, we've seen 2 interest rate cuts, and the expectations for a possible cut in December, not guaranteed, of course. And any cuts next year definitely will positively impact the markets, as a lower borrowing cost is always good for investments overall. Trade policy uncertainty, we should see hopefully a diminishing of the uncertainty, as this week there were positive trade negotiations between China and the US, China being the US biggest trading partner, and that any instability in that relationship has definitely negatively impacted the market. So overall, hopefully positive sentiments in trading going forward, because trading policy uncertainty definitely has impacted this market this year. Geopolitical tensions that over the last few years that has impacted the market, and any flare up in any region, be it in Europe with the Russia-Ukraine tensions or Middle East, could again impact the market. So that's something always on the horizon investors should be mindful of. But generally, market sentiments continue to be relatively buoyant in the international space. We've seen marginal dips in the market, and any dip is always be short-lived, and markets have recovered. So we expect this to continue as we come to the end of the year and next year. Despite the rich valuations, we're seeing earnings growth, and this should filter into the overall market performance positive going forward. Next year, we may not see the level of appreciation we've seen this year, but definitely there is that possibility into the new year, as we've seen some relative stability, and I say relative, in market overall, and generally investor sentiments continues to be relatively positive. If you have any questions, please feel free to reach out to us. You could call us, email us, or visit our website and see what we have available. Thank you for joining us this morning, and do have a wonderful day.